And welcome back. Fannie Mae just announced their latest housing market forecast for 2023 and actually 2024 as well. They are predicting that home sales for existing houses will fall to a 13-year low this year. They're also predicting that home prices will fall for the last half of this year and also into 2024 as well. So in today's video, I'm going to share the latest housing market forecast through 2024. They actually just released this report a couple of days ago, which was on June 26. So of course, I have a lot to share. Let's go ahead and dive right in. This again is according to Fannie Mae, published on June 26. It says here, a lack of houses for sale, I would say for existing houses, is supporting home prices and of course, new home construction as well. I made a separate video regarding new home sales. I posted that one video before this one. So if you guys didn't see that one, take a look at that because I reported how new home sales increased by 20% this May compared to last May due to, of course, a lack of resale houses for sale or lack of existing houses for sale in the U.S. overall. Fannie Mae also says current housing market dynamics continue to be fueled by the lack of existing houses for sale, a trend that did not improve during the spring home buying season when more homes are typically put on the market. So of course, every spring we tend to see a huge increase in the number of new listings, whereas this year we did not see that. So I haven't shared this chart with you guys in quite some time. This is according to altosresearch.com, a really good website that goes over what do they have here? Home prices, days in the market, price per square foot, price increases and decreases, as well as housing inventory for existing houses. So for the 7 days ended June 23rd, there's approximately 460,000 homes for sale. 1 year ago at this time, 441,000. 2 years ago, 359,000. But going back to pre-COVID levels back in 2019, 967,000 homes for sale versus only 460,000 right now. So approximately 52% fewer homes for sale compared to the same time frame back in 2019. Also, one more thing I do want to mention is that back in 2019, like we do see each and every year during a normal housing market, not like 2021, 2022, or 2020 for that matter. But back in 2019, as well as 2018, inventory levels tend to peak in these summer months. As you can see back right here, inventory levels peaked around August in 2019. And in 2018, they actually peaked around actually in October. So it's a midsummer to early fall each and every year. We tend to see an uptick in the number of houses for sale. I do want to mention that because last year this time, inventory levels were absolutely spiking ever since really March last year. Whereas this year, inventory levels have been increasing, but a very small clip ever since May this year. So we haven't seen this big increase of inventory levels like we typically see during this time of the year. And also because we're not seeing this giant increase of inventory like we saw last year, this is really due to the fact we have a lack of new houses hitting the market. So according to Redfin, for the 4 weeks ended June 18th, the most recent stats we have from them, new listings fell by 24% compared to last year. There was only 89,000 new listings over the past 1 month, 1 year ago, and also in 2021 as well. At this time, there was around 117,000. Therefore, over the past 1 month, we're missing approximately 28,000 new listings on a national level. Going back to Fannie Mae's report here, it says this lack of houses for sale for existing houses is being supported by a return to home price growth in recent months. In other words, an increase in home prices over the past several months. So here's our good Uncle Fred's website. The source here is a National Association of Realtors. So home sold prices, or I should say the median sold price, has been increasing ever since February this year. and also has been increasing greatly in March, April, as well as May. And this translates to a 9.7% increase in home sold prices ever since January this year, when the median sold price was $361,200. So what Fannie Mae is saying here is that because we have historically low levels of inventory, this is actually causing home prices to increase even though rates are around 7% and have been around 6.8 to 7% for quite some time here. This is also causing a boost in new home construction as well. A boost of housing starts for single family houses as well as new home sales as well. Again, I made a separate video regarding that according to the US Census Bureau, but new home sales increased by about 20% from May 2022 to May 2023 on a national level. Also, according to Doug Duncan, who's a senior vice president and chief economist of Fannie Mae, he stated the following: core inflation remains sticky. In other words, we're not seeing core inflation decrease like the Fed wants it to see, or like the Fed wants to see, I should say. So core inflation remains sticky, having not fallen as rapidly as other price measures, such as gasoline, for example, energy. So this is creating an upside risk to the federal funds rate. So in other words, they're saying here, because inflation is not going down as much as the Fed wants it to, this is actually going to cause the federal funds rate to potentially increase this year. And also, according to Fannie Mae, it's also making it more likely in their view that it maintains, or the Fed maintains, a restrictive posture for longer than most participants initially anticipated. So according to that, here is the expectations for changes in the federal funds rate. So the next meeting is actually in 27 days, which is on July 26. So the current federal funds rate is at 5.25%. So by a 81.8% probability as of June 28th, the expectations is a increase of 25 basis points up to 5.50%. After that, they're predicting for their next meeting, which is on September 20th, a pause in the federal funds rate at 5.5%, again at 70% probability. The next meeting in November is also calling for a pause as well by a 59% probability. And by the time we hit the end of December, I should say December 13th, their last meeting this year, they're also forecasting we're going to be at 5.5% again, a 52.4% probability. So therefore, the street is expecting the Fed to increase rates by 25 basis points or 0.25% in their next meeting in about a month, and then pause for the remainder of the year. And again, this does have an indirect effect regarding mortgage rates we're seeing today. So today's rates have already baked into the fact that the Fed is going to increase rates in their next meeting. So speaking of rates, the average 30-year fix for people with great credit, according to the Mortgage News Daily, is at 6.91%. A jumbo is at 6.77%. And FHA and VA is around 6.63%. So 1 year ago, for a 30-year fix, was at 5.95%, an increase of 0.96 percentage points over the past 1 year. One more thing I do want to mention regarding rates is that average 30-year fixed rates have been at or above 6% ever since September 13th last year. Okay, let's get back to Fannie Mae's real estate market predictions here. So according to Doug Duncan, he says, meanwhile, home prices continue to show stronger growth than was previously expected given the suddenness and significant magnitude of rate increases. So based on their previous forecasts, they were expecting that home prices were going to soften because rates have increased so much. Rates in 2020, 2021 were around 3%. Now rates are around 7%. So it says here that because they weren't expecting to see this strong home price growth because rates were increasing so much this year. It says here, housing's performance is a testimony to the strength of demographic-related demand in the face of baby boomers aging in place. In other words, not selling their houses. So baby boomers aging in place and Gen Xers locking in historically low rates, both of which have helped keep housing supply at historically low levels. Meanwhile, home builders continue to add to that supply of houses for sale, for new houses, of course, but years of meager home building over the past business cycle means the imbalance will likely continue for some time. We do expect housing to be supportive of the overall economy as it exits the modest recession they're forecasting. Speaking of a potential recession ahead here, it says the current pace of consumer spending remains unsustainable, given the current income levels, and to date has been supported by drawing down pandemic-related savings and tapping into increasing debt. Since January 2020, real personal consumption is up 8.5%. So spending by U.S. households have increased by 8.5% since January 2020, while disposable personal income is only up by 2.7%. I'll say that's not sustainable to see wages increase by 2.7%, but consumption levels or spending increasing by 8.5%. This divergence will need to converge, creating downward pressure on consumer spending growth relative to income levels. We expect the continued tightening of credit conditions, slowing bank lending, and shrinking money supply will eventually lead to a downturn in the business cycle, and of course, coinciding with a recession. All right, let's talk a little bit more about their housing market forecast this year as well as 2024 regarding single-family housing starts and also new home sales, home prices, as well as rates as well. So regarding housing starts for single-family, they are predicting that housing starts for single family will decrease by 18% this year. Let me just zoom in here. So 18% decrease this year, but a 2.5% increase in 2024. Regarding home sales, for new single family home sales, they're actually calling for home sales to increase by 1% this year and then to fall by 3.6% in 2024. Now here's where it gets really interesting here, because here's their forecast for existing houses. So for 2022, there was 5,030,000 home sales. That was a decrease of 17.8% compared to 2021. But their forecast this year is a decrease of 16.2%. So 4.213 million or 4,213,000 is our forecast this year, which, by the way, that would be the lowest levels or the lowest number of houses that were sold going back to the year of 2010. So in other words, they're predicting that home sales for existing houses is going to fall to a 13-year low this year. And also in 2024, a slight increase of 3.2%, but at 4,348,000, that would be a 12-year low regarding home sales. So let's first talk about 2023 here. Not talk about, let me just share some data regarding this. So for 2023, they're calling for 4,213,000 closed home sales. So here's a chart I have from the National Association of Realtors here. So again, last year, 5,030,000. In 2021, 6.1 million. But at 4.2 million, that'd be the lowest levels going back to 2010. Back then, there was 4,190,000 closed home sales for existing houses. In regards to home prices, Fannie Mae has what's called their home price index, or their HPI. So they're actually calling for their index here based on home prices to decrease by 1.2% this year, and then a fall again by 2.2% in 2024. In any case, when looking at the second half this year, they're actually calling for prices to decrease even more, to decrease by 1.2% in Q4. Then in 2024, which is right here, they're actually calling for prices to decrease further and also to end the year overall down by 2.2%. What I found to be very interesting about this is that they're calling for prices to decrease more in 2024 compared to 2023, even though they're calling for average rates for 30-year fix to actually fall starting in Q4 this year, and to end the year in 2024 at 5.9% overall for the year, whereas this year overall at 6.4%. So I'd love to hear from you guys. What do you guys think about their real estate market predictions for 2023 as well as 2024? One thing I think that they're actually kind of spot on is their huge decrease in home sales for existing houses, but an increase in home sales for new homes because we're seeing a lack of homes for sale in the resale market, but builders are really taking advantage of that by offering incentives for home buyers in order to drive home sales for new houses. That's my biggest takeaway, and also I think that's spot on. But what do you guys think? Of course, I'm not a real estate market fortune teller, and of course, time will tell. Thank you so much for watching today's video, and I'll see you on the next one.